what we're going to go over here today is the Accord 126, which is the general liability application. With that being said, what I have up here in front, again, I used Acord Advantage to get this application, but this is the Accord 126, the general liability section. And as we discussed last time on the 125, you would complete this application anytime that you need liability coverage on commercial lines, and you would just fill this out along with the 125 that you fill out each time. So without further ado, let's go ahead and just kind of get clicking through here. So first off, we just start with the easy stuff, today's date, and then if it's Access Plus, you would leave this information up here blank, agency and carrier and that sort of thing. You can fill this in if you're sending it in through your own office. However, we do want to put down what date you would like this policy to be effective. So we're just going to say it's due on the 15th of March. And again, we need to put down the policy applicant's first named insured. And as we discussed last time, if it's a sole proprietor, we would just put down the sole proprietor's name, doing business as, whatever the business is. Or if it's in some sort of a corporation, an LLC, we would actually put down the name of the LLC or corporation, because that would be the entity. Okay, so depending on what the named insured is, that's how that would be. And then, and if anyone has questions on that, I'd be happy to help them. Next down here on the commercial general liability section, we're going to obviously check that. I don't know why they put that there. We check it every time. And then we have a decision to make. Either we're going to write this policy as a claims made basis or as an occurrence basis. Okay, now we get into some fun stuff. Most policies are written on an occurrence basis. Okay, claims made and occurrence, the difference between the two is basically on a claims made policy, the policy in force at the time the claim is made is the policy that pays the claim. On an occurrence-based policy, the policy in effect at the time the occurrence happened is what policy pays the claim. So let's take a school, for example. Let's say back when I was in high school, the band room that I was in, I'm pretty sure the ceiling was made out of pure asbestos, and whenever it rained and asbestos particles would drip in, maybe the powder would get in my lungs or something. Well, down the road, let's say I developed some sort of a condition and I decided to sue the school because it was the asbestos that caused this lung condition that I have. Now, if the school is written on an occurrence policy, which most policies are written that way, what that means is that if I sue them and the occurrence happened back in like 1985 or something like that, then the 1985 policy is the policy that would pay, because that's when the occurrence happened. Okay, so if their limits were lower back then, which I'm sure they were back in 1985, and let's say this happens 10 years in the future, then you're going to have lower limits than you probably need to handle a lawsuit in modern times. Now, in most cases with schools and institutions where this can happen, where someone sues them for something that happened in the past, like let's say an E&O policy, then those should be written on a claims made policy. Meaning that even though the occurrence happened, the asbestos went into my lungs back in 1985, I make the claim in 2025, the policy in 2025 is what's going to actually pay the claim. So if they have like $5 million per occurrence limits then, that's going to pay the claim versus $500,000 limit back in 1985. So that's the difference between a claims made and an occurrence policy. And a lot of times you see claims made policies for businesses that are like institutions, like schools, churches, that sort of thing. And E&O policies are another example of a claims made policy, because you might have messed up 10 years ago, and when they find out that you screwed up on the policy 10 years later, you want it to be your current policy's limits that cover that claim, because obviously inflation and that sort of thing affects how much they'll actually sue you for in present times. So that's the difference between the claims made and the occurrence policy. Now, if you're thinking about something like a contractor or like a bar, generally the occurrence that's going to happen is they get in a bar fight or something, or someone hurts themselves, slips and falls or something like that. that's going to happen like now, and as you can imagine, an occurrence-based policy is much cheaper than a claims-made policy. So that's why almost always you'll choose occurrence unless it's like an institution or an type of policy. So that's an example of the two. You can get a lot more information on claims made versus occurrence in Rough Notes, as well as CIC classes, which I encourage everyone to take at www.scic.com, and they go into more detail on that in the commercial casualty class. So anyway, but that's the Josh Notes version. The limits. This is going to be. We'll just go down the list here, and I'll explain each one a little bit. General aggregate means the total that the policy pays for property damage or bodily injury over the course of 1 year. Aggregate meaning 1 year. Okay, so I'm going to use what I call quote-unquote standard limits, although it depends on the risk. But in this case, I'm just going to put down $2 million, so that there's $2 million in property damage and bodily injury coverage for the year for this business. Okay, and I'm going to explain a little bit more as we go into this here. Now, I'm going to jump down to each occurrence, and I'm going to put down $1 million. And this means that, and I wish that they put down each occurrence for bodily injury and property damage, because that's what this means. Now, to explain a little bit about this liability section in general, it's important to note that liability is determined on a case-by-case basis, and it's based on the insured's negligence as to what is paid. Now, there is a section down here, medical expense, which basically allows you to put an amount in. I'm going to use, again, another common limit here, $5,000. And basically what this means is, if a person comes to your business, they slip and fall, or they get hurt, or something like that, and it's under $5,000, you don't have to go to court over it to prove that your business was negligent, and they'll just automatically pay whatever the limit is as long as it's reasonable by the claims adjuster, but you don't have to, again, go to court and have it proven that you were, in fact, negligent. Now, this opens up a small can of worms. Some businesses like this number to be 0 because they don't like treasure hunters that go around slipping and falling in businesses to collect health insurance or because they hurt their back or something like that from another injury. So they'll have this set to actually 0 so that every single time there's a claim, they either, one, pay out of pocket and they don't raise their liability or premium that way, or two, they want people to have to go to court over it so that way they can avoid that situation. So some businesses like it to be 0. You'll have to just talk to your customers, and it probably depends on your area. A common limit, again, is either like $2,000, $5,000, or $10,000 as well. But that's what that medical expense does, is it allows coverage without having to go to court. Quick little coverage there. Now, what we're going to get into here, though, with these different limits up above, is the general aggregate, again, meaning the total amount that's going to be paid per year. This is the total liability payout for the 1 year period. Down here we talked about each occurrence, actually meaning each occurrence for bodily injury to another person, not an employee, but like a patron or a customer or a client of some sort, and property damage to another person or patron or client's property. Again, not to be included in like employees. Employees is where like work comp would come in for bodily injury. Okay, so that's where this is the limit of each occurrence for another person's bodily injury or property damage. Okay, going to build on that now, so we got that down. Building on that, we go up to, let's just start at the top and work down. Well, actually, I take that back. Let's start with personal and advertising injury. What this is personal injury, different than bodily injury. Personal injury, I always think of like taking things personally. Like, you said something and I got ticked off at you, I'm taking it personally and now I'm going to sue you about it. That's just an easy way I used to remember it. But basically what it is if you say something, let's say wrong in a newspaper article or an interview that slanders someone else, or they say that because you said this I lost business, now I'm going to sue you for the business that I lost. That's what the personal and advertising injury, and like let's say you accidentally do something wrong in something of your advertisements, you're not causing anyone's like body any damage, and you're not like hurting their property, but what you are doing is hurting their business because of something you said or wrote or something to that effect. So we're going to put down again, usually this is the same limit as the each occurrence, which is usually half of the general aggregate. And then okay, so we're going to let that sink in for just a second. Products and completed operations. Products and completed operations are two different things, but they've grouped them into one limit here. A product is something you make. So if you're obviously making food, that would be the product. If you're making like some sort of a bike or something like that, that's your product. If you're making a house, the house is your product. Okay, and essentially that's the if you make something and then it causes injury to someone and they find you negligent because you made it incorrectly, then you can be sued, and this is where it would be covered. So if you obviously need products coverage, this is where you would put that amount, and we would again just put down the $1 million or half of whatever the aggregate is usually in most cases, and this would depend on how much exposure there is as to how high of a limit you'd want here. Now, on the completed operations, which is kind of a different thing, the way this works is for bodily injury and property damage, you have coverage wherever you're working. So if you're at your office, that is your premises. So if you're like a bar, generally your bodily injury and property damage coverage is on your bar's premises. Now if you're a contractor, you might not even have a quote-unquote premises, you might work out of the back of your truck. Well, if that's the case, when you're at a job site, your premises is while you're there, while you're working. Once you leave that job site, that premises coverage leaves with you. So once you leave the job site, you no longer have this coverage right here, which is why it's very important for contractors to have completed operations coverage. What this means is that anything that you do, let's say you hang a mirror over a nice tile floor, and it's a very elaborate heavy mirror, and after you leave, the mirror falls and breaks and ruins the expensive tile floor. Now, you wouldn't have coverage under completed operations for the mirror itself that you maybe sold them or hung, but what you would have coverage for is, that would be in the cases if you made the mirror, you wouldn't have coverage for it, but you would have coverage for the tile floor itself, that because of your work that you did that failed, it caused damage to their property, to their actual property that they owned. So to kind of tie that up, you wouldn't have coverage for your actual workmanship. Okay, that's different coverage. You wouldn't have actually coverage for, like if you were a plumber, the pipes you installed yourself and you charged them for. But if your pipe broke and caused water damage to the wall, the property damage that was damaged because of your faulty installation there, that would be covered, the actual property that they owned before. So that's completed operations, and again, that even goes into some instances where you're building a house. Again, the house would be the product, but if you left a bunch of nails in the yard and some kids stepped on the nails and it was because of your negligence that they injured themselves even after you left, that would be the completed operation. So very important coverages there, and it's important that people realize the differences, because I've seen these left blank too many times in a lot of actually existing policies out there. So let me know if anyone has any questions over that, because that's a pretty big factor here. Damage to rented premises. What this is, I wish they said damage to rented premises fire, because what this is here is damage to a premises that you're renting. So like for example, if you rent an office building, and you're, in this case like the bar, if they're renting a building that they have their bar in and they cause a fire because of their negligence, again because of their fault, then that they would have coverage on their insurance policy, because the landlord a lot of times will then sue the person who caused the fire, because that's usually built into leases that they're responsible for that. So if the building's worth $500,000, you're going to want to have $500,000 in here. So this should be the limit of the building, or maybe a little more if you'd like, if you're renting the building or renting the premises that you're operating out of. If you're not, the lowest amount you can put in is $50,000. Okay, so you got to have a limit here, $50,000 and up, based on whether or not they rent the building and that sort of thing. Now, employee benefits down here is basically if this business pays their employees benefits, okay, let's say health insurance, and if they screw up and basically they forget to like send in a premium payment or something like that, which causes their employees to lose their benefits for a month, and all of a sudden one of their employees gets sick and then they don't have actual coverage, this will pay for the mistake, or this will pay the coverage that they should have had, or whatever they're being sued for in this case, within reason, of course. Again, it all goes to court, for the employer's screw up of handling the benefits. Okay, it's not like health insurance here. It's basically if they screw up the health insurance or screw up the 401k or something like that, whatever they do in terms of benefits. So, you know, whatever you want your limit to be here, you would put in based on whatever, you know, limit, or based on whatever services they provide. In some cases it's 0 if they don't offer benefits, but that is a very important coverage, and again, something that gets left off. And by the way, before we move to the next section, all of these things right here is how you survive in the hard market. I've just kind of got it on my brain right now because I sent out that email. But selling coverage that maybe isn't currently in the policy that they really need, that they have a risk for, is ways that you can obviously sell a policy even though the premium is a little higher, but you're actually selling them an actual policy rather than just a bunch of pages stapled together. Okay, that's my soapbox. This stuff, to get a quote, you can leave blank. If there's any additional coverages or anything like that, like, I guess I will add, like hired and non-owned auto. If they don't have auto like coverage for any owned autos that they have, like if they don't own any autos, but they, for example, you've got a contractor, heaven forbid he doesn't have it on a commercial auto policy, and he just has it under a personal policy, for example. At the very least here, you should always put down hired and non-owned auto liability. And what this is going to give in terms of this bar, or in terms of anyone who has this coverage, is it's going to give them coverage for when they get behind the wheel, or when their employees get behind the wheel of a car that isn't owned by the business. It gives them liability coverage, because as all of you know, if an employee drives their own car and they go down to the grocery store to pick up some more booze or hot wings, and they drive back and they accidentally hit some kid on the way back or something like that, and they've got a whole bunch of business stuff in the car, their personal policy is not going to want to pay that. And that's when you get into an issue where then it's actually the business that's responsible for that. So that's why you always want to have hired and non-owned auto liability. And if you can't include it, like for example on the business auto policy, because there's an actual box to check on the Accord 137, then that's where you would want to actually write it in here on the general liability section. So again, selling coverage, and it's a very important coverage to have because it's a common claim. So I don't see any questions yet, so I'm going to keep moving along here. Moving down to schedule of hazards, this is actually not too tricky. Let's say, like in the instance of our bar, I think from the Accord 125 we filled out, we had 2 locations, 2 addresses. Okay, so at location 1, which is at address 1, we have, let's say, 1 hazard. I might change my example. Yeah, we'll keep it. Okay. Yeah, I'm going to change it. Sorry. Joe's HVAC. Okay, heating and air. Make this a little better of an example to send out to everyone. Okay, classifications. This is what they do at location 1. Okay, so at location 1, let's say that they HVAC service and repair. Okay, they just service air conditioners and repair them, and they service and repair heaters and that sort of thing. That's all they do. Okay? I don't know the class code, so we're going to leave that blank in this example. Okay? And we can still get a quote without it. Now, the premium basis down here is what we use for that, and in most cases you'll either use the sales or the payroll. In some cases you'll use the area or the unit. How to know what to use here is pretty simple. If all else fails, go with the total annual sales, but the general rule is if it's a contractor, you use payroll. Okay? If it's a landlord just insuring property, you go by square footage. And if it's some sort of an apartment complex or a hotel, you go by units. In other words, how many rooms do they have? Okay? So in this case, we're going to actually use a couple. The first one we're going to use, since this is like a contractor type thing, we're going to use payroll. Okay? And the exposure is just the amount of payroll. We're just going to say 150,000. Whoops. Yeah, that's fine. 150,000. Okay? That's all I need to do there. Now at the second location, we've got one hazard. And let's say it's also HVAC, service, and repair. Again, we're going to use payroll. Again, let's say that we have 75,000 in payroll here that does service and repair. And then, let's say that at location 2 we've got another hazard. Let's say sales, retail sales, because they sell AC units or something like that. Okay? Now, here, again, it's sales, not a contractor type of job. We're going to go by annual sales. So S for annual sales, and let's just say that they do $200,000 in annual sales. And that's all there is to it. You leave all this blank, and again, if you're taking notes here, sales is for anything and everything pretty much. Payroll, and the exceptions are payroll for contractors, area for landlords, with the exception of units for landlords that have apartment complexes or hotels. So, not too crazy there. Gonna just scroll on down. If it's a claims made policy, you'll answer these questions. Most of the time it's not, so for this example, and to stay on time, I'm not going to go into these. Employee benefits. If you have employee benefits, here's where you're going to want to fill this out. Again, I did choose the employee benefits, so I'm going to put in a deductible. So we'll say $2,500. Oops. We'll say we've got 5 employees, and we've got all 5 of them are covered by benefits. And the retro date is how far back the policy covers for. In this case, we'll go back to the previous year. Oops, I think it was 3/15/2011. So, that's all there is to that. Nothing too crazy. I'm going to bounce over to the next page. Okay. If it's a contractor, we'd answer these yes or no questions. Thank goodness I changed my code, because that way I can fill these out. Okay, we're going to just put yes or no here. Do they do plans? If they do, we need to explain it here. If they don't, just put no. Any blasting or demo work, any excavation. Do you have subcontractors that carry limits less than yours? I'll talk about that in just a second. Do they work without a certificate? That should be no. And do you lease any equipment? That's usually yes or no, but just explain anything. Whoops. Any yes answers here. Okay. Okay, sorry. Now, this section here, contractors, absolutely must be completed. If it's 0, put 0. In fact, that's what I'm going to do. We pay $0 to any contractors. We subcontract 0 out. We have 5 full-time staff and we have 0 part-time staff. But there has to be a number in each one of these boxes, or the darn companies don't give us a quote back. Describe the type of work contracted. None. Now, subcontracted means that if they subcontract, of course, like if they're a carpenter that does woodwork, but they also maybe do some plumbing, then this is where you would like say plumbing, and then how much they actually pay the plumbers to come in and do the work. Now, I do have a question that popped up here. If a contractor, like in which case almost always happens, that a lot of times they work out of their truck and they don't actually have a location. Now, what do you do on the last page where it says what is the location? In that case, you're always going to put location number 1, and on the Accord 125, when it asks for location, you'll put location number 1, building number 1, and that's usually their home address. And when it says area open to the public, that's going to be 0, because generally they don't have customers come into their home. So that is a very good question and very common with contractors. Just put location number 1 and then however many different types of hazards they do based on what type of business what type of work that they do. And the more you can split it out, like if they do if they do air conditioners or heating, or they also tend to do some like handymen may have like 10 different hazards that you schedule. But it's important to break all those out because otherwise they're grouped under the most expensive of all the categories if you don't break them out in some cases. Okay, and we obviously at MIA will provide assistance there as needed if you have any questions. Now, with heating and air, we don't have any products in this example. So I'm not going to actually answer this, but if there were products, you would need to answer this question here, like if they sold or made and sold things. Okay? And this is all pretty self-explanatory, but in this example, it doesn't actually apply. Now here, we just answer yes or no on all these things again. I put no, whoops, no, hold harmless, no, nope. No. Now, of course, if any of these were yes, you would just explain it in the little remarks box. Next. Okay. And, okay, now, one other question that I have, and this is a good question, is back when we're talking about subcontractors, if let's say they don't have any employees, but the actually owner itself does the work, you would actually, I think for clarification purposes, you'll always put down 0 employees. So if you have like a one-person operation, for example, when it says number of employees, you'll actually put 0. If they subcontract work out, you would answer those questions, like how much they subcontract and stuff. But whenever that comes up where it's like just a one-person operation and it says how many employees do they have, sometimes you're like, well, do I put 1 since he's the employee? You would actually put 0 just to not cause confusion to the underwriter at the carrier in making them think, well, is it the owner plus an employee? I've just tended to find that be the easiest way to do that with the least amount of questions bounced back. With any risk, you'll always answer these general information questions, and again, just more of these yes-no things. Again, if any of these are yes, you would just explain why. Okay. Okay, no. Oops, I wish I could tab here. But of course it would take me through all those little boxes. Okay. Next. Okay, finally. Oh, still more yes-no questions. Okay. And that actually is going to be it on this. Okay, so one of the questions that I had is back here under employee benefits. Let me see if I understand here. So this one here is employee benefits liability, and up here you have employee benefits. The reason why they did this and they broke it up into 2 sections, this is actually pertaining to the same actual coverage. This is the limit right here, and then down here is the questions. And the reason why they did that is because it just basically is an extension of that limit. The reason why they broke it up into 2 sections like they did here is because, for example, if it's not claims made, you wouldn't have to answer this box. And for example, if you had 0 employee benefits, because some businesses don't pay benefits, then you would just not have to answer this box.